This stock makes money, it's growing, and it costs less than $2. Yet almost no one is talking about it. While everyone is staring at AI hype, a turnaround could be quietly happening here. And if the market realizes this, things could move very quickly. In this video, I'll show you whether there's another hidden opportunity here or a classic China trap. Today it's all about the penny stock Waterdrop. Waterdrop is a Chinese insurance company, which means digital insurance instead of traditional agents. Everything basically runs through a platform, an app, through data. The company connects millions of users directly with insurance providers, meaning no branches, no paperwork, no traditional field agents. And this is exactly where the difference lies. China has significantly lower insurance rates than Western countries. So many people in China are not insured, especially in the area of health insurance and health protection. But Waterdrop solves exactly this problem. The platform analyzes user data and then recommends the appropriate insurance product. In other words, the entire process is completely digital, fast, simple, and without complicated consultation meetings. What's special is above all the business model. Waterdrop doesn't sell its own policies, but rather acts as a digital insurance broker, so to speak. So the company earns commissions, especially from new contracts, but also from renewals. This naturally leads to recurring revenues. The second point is also the user base. Over 100 million registered users are already providing data. And of course, data also means better risk assessment and better product recommendations, as well as a higher conversion rate. And that is also the technological advantage. It's not hype, but truly a data-driven insurance platform in the Chinese market, and it's also a scalable platform model. Let's move on to market capitalization and the upside potential. Waterdrop, clearly a small cap. But this is exactly where there is always leverage for a portfolio because the company operates in an insurance market with over $1 trillion volume in China. In other words, when a small player like this gains market share, it always has a disproportionately large effect. But of course, market size alone is not enough. What really matters is the company's position in the market. So now let's move on to market position and competitive advantage. Waterdrop is the second largest digital insurance broker in China, with over 117 million registered users and more than 100 insurance partners. So this is no longer a small startup. The platform has real market relevance, but size alone is of course not yet a moat. The question now of course is, how well can all of this be scaled? Because this brings us to scalability and future markets. Well, everything is digital. No branches, no traditional structure. This naturally means high scalability, and more users, of course, hardly result in any additional fixed costs. At the same time, expansion into Southeast Asia is being considered. But growth is, of course, only attractive if it is profitable. Let's move on to problem solving and the question of what the demand is actually like. China has a lower insurance penetration than Western countries. In other words, many people are underinsured, especially in the important healthcare sector, and Waterdrop ultimately solves this with a digital solution. Fast, simple, and accessible. But this also solves the profitability problem for most. Now let's move on to the long-term growth strategy. What does that look like? After regulatory changes, Waterdrop clearly shifted its model to a brokerage, meaning away from risky structures and towards profit-based revenues. Of course, this reduces balance sheet risks, but a strategy is only ever as good as its execution. So, how does it look in terms of strategy and vision? Here, Waterdrop sees itself as a digital insurance ecosystem, meaning with AI-powered matching, data-driven product recommendations, and the company naturally leverages its huge user base as a data advantage. But data is only valuable if in the end it actually delivers better results. Let's take a look at the management and leadership. CEO Shenbo comes from the fintech sector, which is extremely interesting. The company has experienced regulatory setbacks in the past but has been profitable since then. This, of course, also demonstrates adaptability. But management qualities are especially evident in times of crisis. Let's move on to cash flow and balance sheet strength. The debt level is extremely low. The debt-to-equity ratio is about 0.05. At the same time, operating cash flow is positive. Cash flow per share is around $0.16. That definitely provides stability. But stability alone is of course not yet an investment case. That's why let's move on to the competitive comparison. When you compare Waterdrop with others, one thing stands out. Waterdrop is valued significantly lower, but is more profitable. By the way, if you're interested in such comparisons, stock analyses or cryptocurrency analyses, then take a look at the 10x universe. I recently did an interesting stock analysis that will surprise you. Feel free to take a look. But why is the stock still so cheap now? Let's talk about debt. The extremely low debt level naturally also reduces the risk of insolvency. This is particularly crucial for small caps. Many penny stocks fail due to high levels of debt financing, not Waterdrop. But what about the valuation now? The valuation. The price to book ratio is at 0.65. This means the market values the company below its equity. For a profitable insurance tech stock, however, that's unusual. Either the company is undervalued here or there are hidden risks. Now let's move on to liquidity. As a small cap, the trading volume is of course always limited. This leads to strong price fluctuations, especially when there is news. Of course, this can be a risk, but it can also be an opportunity, depending on your investment style. Let's move on to the free float. Over 97% free float, hardly any insider dominance. This definitely increases market transparency and naturally also reduces structural risks. But trust is also built through a brand. Now let's take a look at market strength. In China, Waterdrop is definitely well known, hardly at all in the West. The brand is solid, but it's not dominant. Nor is it a global brand. But of course, brand isn't everything. The business model is more decisive here. 85% of revenue comes from commissions, recurring income through renewals. Of course, this means there is no own insurance risk, and naturally, this also reduces balance sheet fluctuations and makes the model capital light. But how stable are these renewal rates in the long term? Let's move on to the insider structure. The founder holds a significant stake. Institutional investors are also involved. The structure is already quite diversified. That does indicate trust. But of course, the question now is, how does the community respond to this? And what is the shareholder structure like? Institutional names like Vanguard or BlackRock are invested. This shows that the stock is not being completely ignored, but institutional money alone does not drive a revaluation. For that, you need catalysts. But first, what about the community? Well, Waterdrop holds earnings calls and also publishes transparent reports. That's a good thing. But now I'm interested in your opinion. Do you find Waterdrop interesting and would you buy Waterdrop? Write it in the comments. With small caps, a community is often crucial, especially the sentiment. But now let's take a look at sustainability. Well, the model is digital, less paper. The focus is of course on health protection. There also haven't been any major scandals here, which is good, and for institutional investors that's increasingly important. But ESG alone doesn't move share prices. What moves share prices? Well, milestones news. Let's get to that now. What are the catalysts? They want to expand, create new products, grow in digital insurance, and a possible revaluation with increasing profitability. Small caps, of course, always react more strongly to surprises, and that's where the asymmetric potential lies. But timing remains the most difficult factor. With 78.25%, that's how high they rank on my 10 times ranking list, which I'll show now. By the way, I've analyzed many altcoins in the crypto sector there, but now also increasingly in the stock sector. So everything is analyzed in one list. In the end, they are a small cap. Waterdrop is not a high penny stock here, but a profitable insurance tech stock. With over 117 million users, they are also well positioned, have low debt, and ultimately a scalable platform model. The stock is currently still valued below book value, and that's definitely rather rare for a profitable company. At the same time, however, it remains a China stock with, of course, political risk. The result of 78.25% comes from my 10 times formula. I also evaluated 20 key figures there. I'll display them here for you now. There you can really see how everything is put together. But all the fundamental data is only half the truth. So what does the chart say now? And where are realistic price scenarios, price forecasts up to 2030? We'll clarify that separately now in the chart. Yes, let's go back to the chart analysis of Waterdrop. Definitely an exciting penny stock. I'm using TradingView just for information for now, but let's go straight to the chart. Let's first take a look at the different price scenarios. The bear case would be at $0.66 US. If you look at that, from now on, depending on which exchange you're trading on, that would be minus 55%. The base case would be more around $2, which would be 32%. The bull case would be significantly higher. That would be at $3.2, which would be 112%. Of course, the question remains, what will things look like in 2030? What is the mathematical calculation for that? We'll get to that in a moment. But first, let's take another look at the current situation. You can see that it started out extremely highly valued and then really plummeted. Let's take another look at the current situation. Here on this indicator, we're more in the middle range, as you can see. In other words, if I were up here, that would indicate an overbought zone, meaning a lot of people are buying, we're overbought, and vice versa. Down here would be the oversold zone. That would basically be if the price were to go down and many people would sell. Then we would enter oversold areas. Those would be exciting entry opportunities. But right now we're more in the middle range. Let's take a look at 2030 now. Mathematically calculated, $5 would theoretically be possible in 2030. Let's see how much that would be. That would be roughly over 230%, so quite a significant increase. Yes, but right now I would actually still be cautious because, as I said, we're currently, let's say, in the middle zone. If it were to go down here and, like here for example, we form a green dot, then that would be an exciting entry opportunity, at least for me. By the way, if you want to use the indicator yourself for your stock analyses, but also for cryptocurrencies and commodities like gold, feel free to check it out. The link for it is in the video description. If you want to see more penny stock analyses, I have an exciting penny stock for you right here. It's about electric cars and the fires that occur, and how this stock can help prevent them. All of that is right here.